Looks like we are live streaming. My computer sounds like it's about to take off, so I'm guessing that we're live. What's happening, fellas?
There we go.
Whip that hamster.
What's up, is Value After Hours. I'm Tobias Carlisle. This is Bill Brewster and Jake Taylor.
Oh.
What's happening, fellas?
I'm Ron Burgundy. What's the haps, boys?
I have no clue what's going on.
Yeah, no, I'm right there with you.
Feels frantic.
Let me give a shout out to got Nashville in the house. What's up, Bangalore? 12 a.m. in Bangalore. Kingston, Jamaica. That's the first time. Teslaville. What's up, Samson? Los Angeles in the house. Vancouver, Ireland, Toronto. Offshore Israel still going strong. Good to see you.
Wow.
Toronto, Jupiter, Florida. All right. Hamburg, what's doing? That's a good spread. Rockville. Nice. What's up, fellas? Good to see you all. Evan Tyndall in the house.
Hey, Evan. What's up, my man?
Ben's in the house. Tallahassee. All right. Good spread.
So tomorrow, Daily Journal, got 99 problems and Munger ain't one of them.
Wow. What a run.
What a run.
Inspirational.
What a legend. Really is.
If there's any justice in the world, he gets the ton up for the one more DJK next year too.
Yeah, we need at least 100, right? That would be legit.
What is the oldest director? Does anybody know the statistics on that? The oldest director who's ever sat on a public company board?
Yeah, where's non-gap? Mike, he's probably got that off the top.
Got to be the oldest vice chairman. Got to be the oldest, like in that kind of role.
Yeah, I'm trying to think. Well, who's the oldest CEO of any company? Is Buffett got to be it at 92?
Got to be closing in.
It's got to be in the ballpark, if not already
what
the winner.
About some of that media asset? I'm just blanking.
Oh yeah, Sumner Redstone, or
Sumner stuck around till quite. He was at least in his 90s. I guess
looked like the Crypt Keeper.
News Corp. Murdoch's still going.
Yeah.
How old's Murdoch?
He was hanging with Elon.
Yeah,
gents, I got to take a pause on this for like 15 minutes. I'll be back. Sorry.
All right.
All right, Bill. Yeah. So Elon hanging out with is Twitter going to be bought by Fox? Who knows?
I've already seen that season of
Succession.
Yeah. I think. Does he do the deal? Nah, there's no way he does that deal. Maybe he buys it. I don't know. Maybe he invests in it. It's not crazy. News Corp has spent big money on assets in the past. I think they bought MySpace, didn't they?
I think you're right.
I'm pretty sure they bought MySpace and then they turned around. It was a pretty clever deal because everybody said they've massively overpaid. But I think these numbers are wrong. But this is roughly what happened, that they spent, I think, say $700 million on MySpace, which everybody was like, that's a crazy amount of money. And then they turned around and they sold advertising space. They sold all of the advertising for a period of time to Google for like $2 billion. And everybody went, oh, that actually was a pretty good deal. Something like that. I think those numbers are wrong, but that was a pretty good deal. That's a little while ago though.
Directionally correct.
Yeah, something like that.
Cool.
What do you got on deck today, JT? We'll probably have to wait until Billy comes back, but
no, the show must go on. I have a piece prepared on Parkinson's law, but maybe before that, I'll give some highlights from my trip to New York City last week.
Oh yeah, sounds good. Let's do that.
Do you want to do that time with that? Yeah.
I've also got some. I've got some.
What do you got? Value spread or inversion or what do you got?
I'm going to say this because I love the fact that every time I talk about the value spread, that it's always sunny in Philadelphia get that doing the splits, I can go lower, always shows up underneath the tweet. I'm doing it for that reason.
Okay.
Any prognostications on the animal entrails today? Yeah, you guys know I like all of those little
the auger, they used to call that.
The auguries, yeah.
Yeah.
Yeah, crack I favor the shoulder bone and the fire. You look at the way that it cracks. That's how you determine the future. That's what I found to be the most effective in backtest.
Okay, that makes sense.
Entrails, not so much lower R squared on the entrails. Yeah, value gap is wide, closed a little bit. This is the common stock guys quoting. I think this looks like a Ned Davis chart. It's closed a little bit, but it's still got a long way to go. But Parrot Cap has an interesting one on top. This is not a metric that I've heard of before, but I think it doesn't really matter. The intuition's pretty right. But percent of the top 5 S&P 500 stocks aggregate market cap needed to buy out the average Russell 2000 stock.
Interesting. Never heard that one before.
No, but it's just showing how I guess that's a spread between large and small, wider than it's ever been before, or 30 years of data anyway. You got to think that augurs well. No pun intended.
See what you did there.
or small in value at some point. But I feel like we've been saying that since this podcast started, so don't hold your breath.
Yeah, exactly. None of these are timing tools.
That's right, not a timing tool.
So just to give you some confirmation bias, I attended the Columbia event on Friday of last week, and Cliff Asness was one of the speakers there, and it was great. He was his usual irreverent Cliff self, really funny. But he said that, well, first of all, AQR's 60-40 looking forward estimates for the next, I think, 10 years, he said. Hope you're sitting down. 2.5% real, which is, I don't know exactly what pension funds and insurance companies have plugged into their forward-looking assumptions on their return on stocks and bonds, but I'm guessing it's probably north of 2.5%. So anyway, they're not particularly bullish there.
But they've got access to private equity. They've got all that private equity is going to make up the difference.
Yeah, that's going to be it. He actually had a pretty good comment on private equity that I thought was smart. Cliff said that illiquidity, that it used to be considered a bug, right? And typically bugs within systems in sort of an efficient market approach, which, he came from Chicago's, the University of Chicago, I should say, that you got paid for that for tolerating a bug. Yeah. Well, now that it's considered kind of a feature that, you don't have to, you kind of can insulate yourself if you're an allocator from that sort of career risk. You end up, usually you have to pay for features. You don't get paid for features. So I like that framing. I think it's actually a very clever way of thinking about it.
Yeah, that says there's a problem with it, right? I think Munger talked about it a little while ago. I thought Munger was the first one who I heard talk about it, where he said that the fact that they just they mark to myth is that's the feature that they don't have big drawdowns because they don't mark them.
Yeah. So Asness, the other thing for you, Toby, the value of value, their AQR's current data set, which is a blend of a bunch of different valuation metrics, different places to measure, is at 92 percentile right now, which kind of matches up with Greenblatt's, his value of value or how cheap is value right now. So maybe, another data point that kind of says the same thing, that value is relatively cheap right now.
Yeah, I think that's right. I think that rhymes at least with every other value metric out there.
Yeah, I think so.
So how did Asness got invited to Columbia? That was crossing of the streams. They let the efficient market guys in there.
Well, I don't think he's an efficient market guy actually, but his talk was good in that the whole point of his talk was actually how quants and qualitative investors, active investors, as he would say, they often end up in the same place, but just taking very different routes. So kind of end up holding the same names, discount to some valuation, and the quant guys using, one measurement, and the qualitative guys finding other ways of measuring and comparing intrinsic value and price. And oftentimes they end up in the same place. And so maybe it's not as dissimilar as we might like to believe. Although he did say that he doesn't think that those two should be crossed together in the investment process.
He doesn't like quantamental, does he?
Doesn't like quantamental, but he thinks they should. He thinks it makes sense though to have some diversification from a portfolio level of, quant and qualitative arriving at different places, but to mix them together, you end up with something, you know, Frankenstein that's not as good.
One could just index.
One could just index.
Then you get the blend of all of it.
Market capitalization, weighted, float adjusted, chosen by the S&P 500 committee.
It's done pretty freaking well.
Momentum based.
It has.
Most robust factor.
What size?
Momentum.
The market, yeah. Do you think it's momentum? It's not.
Yeah.
It's not. I mean, it has momentum like features, but it's not necessarily momentum. And it's
I
not
don't
being
know.
selected. It's not being selected.
You load
by
up
the
more on what's been working, so it's in that way. It's
You just load up
kind of-
more on what's biggest, right? You're taking the size side of the the size, whatever that is, large minus small.
Mm. All right, let me hit some more highlights from New York trip. Had a great long lunch with the main man, Dan McMurtry. Shout out to Super Magatu. Just what a really smart and creative and funny guy he is. Like I find myself really rooting for him. After
Yeah,
hanging
Dan's
out
awesome.
some more with him. He's really smart, and I'd like to see him be successful. Let's see what else. Oh, I was going to share. Tom Gaynor gave a talk and had a pretty good analogy that I hadn't heard before. Maybe you guys have, but he said that that interest rates, whatever they're set at, is a lot like the inverse of a curfew. So when rates are really high, and he made the analogy like when him and his wife bought their first house in the early 80s, he had like a 15% interest rate. And he said, like, once you made your payments, like there wasn't a whole lot of money left over really to do anything. But he said that those high rates are like a 6 p.m. curfew, right? Like it's really hard to get into trouble when you work and then you get off and you have to be in the house by 6 p.m. You just go home and go to bed basically. Whereas really low rates are like, he said, is the equivalent of like a 2 a.m. curfew for a 16-year-old boy, and you're giving him alcohol and a fast car and like, putting attractive girls in that car. Like, of course he's going to end up like, it's a recipe for mistakes. There's going to be some problems that happen with that. So I hadn't heard that one before. I thought it was kind of a nice framing of it.
Yeah, that's good. It's a good analogy. Nothing good happens after midnight. I conducted an extensive survey over decades, I think, and I can confirm that that's the case.
Rigorous.
Very rigorous.
Let's see what else. Finally got to meet Jason Zweig in person. What a sweetheart. Awesome guy. Really friendly. Also got to catch up with Michael Mobison again, which is always another amazing person. Just a genuinely nice guy. Like his ego to horsepower ratio is very favorable. And then last one was, I was really impressed actually with Lauren Taylor Wolf, who is Josh Wolf's wife. Not that it matters who your spouse is, but on her own, she's a PM of Impactive Capital. And I was under the wrong impression that their strategy was like kind of like inclusiveness and that kind of thing. But like I don't think that's true at all. I thought it was like some version of ESG, but it's not. Like she does like real work with her companies. Like she knows business and value and like knows exactly like what the drivers of value for her companies are. And like it was very legit. Like I was very impressed with her. So add another person to follow on your list of and it's nice to see, we kind of joke that there's only guys watching the show, which is probably statistically mostly true, but it's nice to see that the fairer sex also being well represented.
Yeah, that was good. Sounds like a good trip.
Was a good trip.
Were you speaking in Colombia? You were attending?
I was just attending and catching up, and a little ulterior motive is I would really love to see Journalytic in Colombia at some point, and just because I think it would be so awesome to have studied Graham and Dodd and Buffett and the lineage coming from that school, and to like contribute something to that, even in my own little minor way, I think would just be very satisfying for me personally.
Yeah, very cool.
Yeah, and I know that there are professors there who the main work product for the students is producing an investment journal for the professors to read and give feedback on. So it's like, well, duh, why wouldn't we be in
Perfect
there?
match.
So yeah, exactly.
Do you have any more from the trip, or should I?
Everyone's probably bored already with these regaling these stories. So let's move on to the next thing.
No, this is good. Especially since I'm gonna have to take another break. And we need you to fill air.
Stretch it out.
I'll
Yeah.
tell you
Do you
something.
see William Green at all?
No,
Did you already say that?
No, he was he's still in Europe. He was visiting. I talked to him, but he was out of town when I was there.
Being all cultured and stuff.
Yeah. Well, I think he was visiting his mom in
Yeah.
England, so
She seems like a lovely lady.
she's got to be right.
Yeah.
Make a kid like that.
Yeah.
Let's do a segue into something that's less serious. I don't know which one.
Whatever.
Fear and greed index.
All right, where are we at?
Definitely more serious.
Haven't been checking it for a little while, but I just thought I just started feeling good, so I thought
Must
about
be.
a week ago I should check in and see where it is. And
Where's it at?
yeah, it's as greedy as it has been in the last 12 months, and it's funny. It's
Ooh.
it picked the top again. It got into extreme greed. It just nipped into that part that is the selling zone, top 20%. And it seems to coincide with the weakness that we've seen in the market over the last couple of weeks.
Undefeated, huh?
It's a remarkably good indicator for how dumb that little indicator is.
Yeah.
It would have had you buying in
if
October.
you were a day trader, would you is that how you would do it? Would you use that for if you just had to be like in and out? And
I don't think I would know what to do on a day trading basis, but in a shorter term, I think you could use it. If you're an options trader or something like that, where you're looking at like a quarter or two, I would certainly use it. I think like if the times that it got fearful in April at the low, and it got fearful in October at the low, and now it's extreme fear in both of those two instances, and it's back to extreme greed now. And it's come off extreme greed a little bit, which just coincided perfectly with the local high here.
The guy that owns puts that wants me to say it's a melt up. Well, he's very excited right now.
he's loving it.
Yeah.
He wants to
I
hear
would just tell him
Meltdown.
he never should have bought the puts. You're just donating money to options market makers, but do your thing, man.
He wants to hear that you're bulled up like crazy right now since you're his contra.
Yeah. Well, Jamie Catherwood says that this reminds him of the 1920s and that we're in the lull before the roaring 20s. He said that's the parallel on his most recent The Investors podcast. So there you go. I'll roll with get ready for the good times.
Remember the 1920s.
What?
He looks pretty young to remember the 1920s.
Yes. He's he found the fountain of youth.
What are the parallels that he sees?
I don't know, dude. You always ask me this. I hear stuff. I parrot stuff. I dispose of things immediately. I think what it was is we had inflation, then maybe we had some deflation. Listen to him on the Investors podcast. And then we had the roaring 20s. So there you go. I don't know. We had a decade of subpar growth. It wouldn't be totally shocking if somehow we're on the verge of some industrial revolution. Also, maybe we're just about to crash and it's going to be famine. Who knows?
That's interesting because that doesn't fit with kind of my understanding of what the 1920s looked like before and then leading into them.
Yeah.
What's your impression?
Well, I mean, you had a forgotten depression in 1920 and 21 where the Fed basically just got the hell out of the way, let prices reset, and it was a complete deflationary event, like a real deflationary event that like wages, everything reset to a much lower level and then grew from there. Well, I don't think we've tried that since basically in 100 years, not the full.
Nor should we. That sounds awful.
Well,
Fucking.
I don't know.
Well,
your
I don't know.
medicine
I
and-
do know. Kick that can down as far as you can. Make sure it's 3 generations away before it comes.
Well, yeah, that's a good in theory until it's your generation that finally like has to deal with all the problems that all the ones before you have been kicking down the road.
Yeah, well, it's working so far.
That's what the turkey thought early in November also.
That's true. That is not untrue.
Well,
Yeah.
in any event, great book on that, by the way, by Jim Grant, if you want to read to really get into the historic, like nitty gritty of it.
The Forgotten Depression.
Yeah.
That's the title.
Yes.
Yeah, I think that we're more likely to be in a little bear market rally here, right? But then I think that's completely that's the consensus, I would say. I think everybody feels very bearish.
I thought you just told me the greed was up at the
Well, that's a good point.
80th percentile.
That's a good point.
Boing.
It's very hard to tell because it's hard to know to what extent the Twitter stream or whatever, the people who I talk to are representative of the main field. Like I did get the feeling through most of the bubble run through the 2020, 2021, or whatever that period was, 19 and 20. I got the feeling through most of that bubble run that Twitter became very much the crowd through there.
They became Mr.
But maybe
Market.
Twitter's, yeah, I think so. Maybe Twitter's not the crowd at the moment, but
I don't
All
know.
right.
You see retail
Thankfully,
participation pretty high right now.
I save things because I know my mind is not a trapdoor. Thanks to partying.
a steel trap.
Yeah.
Yeah,
might
that's
be
right.
a
It is a
trapdoor.
trapdoor.
It is a
Yeah.
trapdoor,
I'm a mess today. Anyway, I think he said, I would say that the period I'm finding most interesting in terms of parallel today would be the 20s, which I'm sure most people know by now, but I found really interesting since honestly COVID started, the similarities and progression and timeline between the late 19s and 20s with today, because while we obviously, at least knock on wood, didn't have or don't have a world war today, it looks like that got avoided with Russia, Ukraine, yada, yada, yada. But 100 years ago, you had a pandemic with the Spanish flu. After that, you had a wave of summer protests around race called the Red Summer of 1919, which was kind of similar to George Floyd's and Black Lives Matter summer protests and demonstrations. Then you had a reopening where things really got kind of speculative and surging to make up for pent demand that had existed while we were all locked down, which also occurred coming out of World War I and the Spanish flu 100 years ago. But then in 1920 and 21, you had this really sharp and severe recession, which was very short. But again, it was a problem. It was a problem of, in that case, rampant inflation very quickly turning into rampant deflation. And it's an interesting period. But then after that is when you got the Roaring 20s. But people kind of like to skip over the part when they talk about the Roaring 20s, yada, yada, yada.
Which part do they skip
so he
over?
sees the parallels today. So
What are they
we're
skipping
gonna
over?
we're gonna skip over that.
no, I mean, you need to listen to. I'm
Yeah.
like,
You're
he
reading
says,
the
you know,
transcript.
came out of the pandemic, then we had a recession, then we had the Roaring 20s. And so today, obviously, the parallels are pretty obvious. We had a pandemic, we had the George Floyd summer, then we had a recession. And now the question is kind of, are we going to keep following roughly in line with the 20s, or that we would be experiencing or on the precipice of experiencing a true like Roaring 20s, or is it something different where the economy takes longer and kind of rebuilds to truly get back to pre-COVID levels? Anyway, that was all AI generated. So if some
Was
of
it
it
really?
didn't make sense, yeah, you can go to the Investors Podcast and listen to Jamie.
AI from the AI listening to the audio and then transcribing it.
Yeah, man.
It's pretty good.
Jason Buck Corey actually, I think, told him about it. It's this podcast listening app, Snipped.
Oh yeah.
And you can like listen and then you just create snips. So like this
That's
is like
brilliant.
a 3-minute snip that I had. And then, you know, here, I'll do my tech. You got tech, I got tech. Look at all that. So you just like request an
Oh,
AI
man.
transcript, and then you got all
That's
the
very cool.
words.
That's very
Yeah,
cool.
it's a pretty
Yeah.
cool app. So
We're
anyway,
not sponsored by Snipped, by the way.
Yeah.
not yet.
Snipped, if
should.
you want to give us a,
Yeah.
we reach dozens of people every week.
Get
Yes,
snipped.
and it's that's a different thing, sir.
Okay.
So, yes.
I think the
Now,
big difference
brought
though,
to you by
between
the Urology Group.
the 20s and now, the 20s started on a very low valuation base. After the recession, it was coming out of like single digit Schiller PE, and now we're, you know, about as expensive as we've ever been before. Like they're only
Pretty
famous
shitty
states above
businesses
us.
back then.
I mean, were they?
They were. There was definitely more market fragmentation. And I think in general, you had more asset heavy businesses. There's a lot more industrial type stuff. I don't think you had like hyper financialization of everything. You didn't have Burger King spin off the franchise or restaurants from the franchisee, or the franchisor economics from the franchisee restaurants, and cram the shitty economics down and float the public entity that has pretty solid returns on capital and lever it 3.5 times. Like, no, you didn't have that stuff.
Well, you kind of did, though. You had utilities at that point were very hot, and you had this, I think it was Sam Unsel, if I remember right, was like leading these, like they would pump the stock up for a utility and then issue a bunch of shares. It was like the early playbook of a lot of the same things.
Yeah, but that's like securities fraud type stuff.
Well, it
didn't rise to the level of fraud.
It came because everyone was so, they believed so much in the captured demand of a utility at that point. This was kind of before we had a lot of regulation around it. So same story about,
I guess you got Microsoft's trading at 22
Amazon
times, Google's trading at 18, Apple's trading at like 22. These are not like the craziest valuations in the world.
True, but not like obviously cheap either, to be fair.
Yeah, but why would they be? Like, why should the market give you an opportunity when everyone is watching it all the time and everybody's got a podcast and everybody's talking about how to freaking buy stocks? Like, why should that market sell off?
It shouldn't, but in order to generate those silly returns over a decade, you need to start from a very low starting point.
Yeah, well,
that's the point I'm making.
The years of silly returns may be gone, folks. Like, I mean,
I don't know.
I don't know.
I mean, I feel like we've said, like, you know, you can take the famous quote about we've reached a permanently high plateau. Like, this is this absence of humility that we see every single time, that we always think we've conquered the business cycle.
Yeah. I don't think it's a business cycle. I mean, sure, the business cycle will come, and, you know, if you're smart enough, like my put guy, sell out, play the cycle, see how that works. I hope you are one of the 5 people, I think, on earth that can actually do that well.
Sell volatility ball.
You know, I just don't think it's not something I'm ever going to be very good at. So I just don't care. It's fun fodder.
I agree.
But like, by the time the headlines come out about the cycle, the market's already going to be gone. Now, unless we have some deflationary crash, which, you know, some perma bears are going to jerk off to and tell you it's always coming. And they've been saying it for the last 8 years. Someday they'll finally be right.
But didn't you just say that wasn't going to happen?
I mean, it could. And yeah, I do think if the economy completely rolls over and people can't service their debt, and all of a sudden you have like this bust, yeah, sure, you could bust again. But like, I don't see why valuations alone, or I don't see why the market's going to present that kind of opportunity, other than it always does. And
yeah,
you know, it always will.
That's what happens. I think that the market just gets complacent because we haven't seen a crash for a while. So people take on too much debt. They get too speculative. They just can't help themselves collectively as a group. It happens every single time. And that is what creates the conditions of the crash.
But how are you invested right now? You're long value. Value is going to get saved in the crash.
Leverage shit goes.
Unlikely that it gets saved in the crash. But that's one of the, you know, as Buffett and Munger would say, that's just one of the things that you have to endure. You have to expect these like 50% drawdowns every decade or so. You have to be able to endure the 50% drawdown. And so I with the idea also that you're going to take advantage of it when it presents itself. So I'm trying not to be.
Not if you got 100% invested before it.
Yeah, you could trade up though into higher quality potentially.
But there are also, you know, there are
game. I trade into lower quality.
There are other outcomes too, though. Like there are plenty of people who sell out when they see the crash, thinking, "I'll sell out now before it gets too much worse." Or, "Oh, I just can't take it anymore. I can't take the constant drip lower," and they sell out. And so, what I try to do by saying, you know, these things do happen all the time, and the conditions do exist where you could see one of these things, is the idea that if it occurs, you're mentally prepared for what's going to happen. And so you're able to sort of, it's not unexpected. It's not the end of the world. This is just part of the course, and you path for the course, and you can invest more at that point, hold on, know that the end will come eventually. But you can't be standing at the top of the blue sky saying, hey, it's just blue skies forever. We're going to be fine from here.
Better have cash.
Or I would suggest, like, and I'm sure everyone listening has their man overboard plan already filled out, ready to go, and they're not going to lose their heads, and they're just going to pull out the procedure and be like, okay, here's the next thing I need to do. And they're ready to go.
Yeah. Yeah, I don't know. I mean, we could go lower. Could go higher. Who knows?
Yeah.
Where's the market going? It will fluctuate.
Yeah.
Well,
I mean, we'll see.
Would you load up on ARC here then? Because it's sold off. It's 2 years from its peak.
It's down a lot.
I don't think Cathie Wood knows what she's doing at all. That's not an index bet. That's whether or not you actually think she knows what she's doing. And
those are the new cues. So,
well, I've talked to enough people that know her names that I mean, I wouldn't be comfortable interviewing her. I would not feel like I was doing my duty to my listeners to interview her.
Interesting. That's a pretty good litmus test there.
Yeah. So, but you know, that guy, Tom Ricketts, that guy's portfolio, I'd probably go long that. I'm not, but I think he's a guy that I interviewed that does innovative investing. I bet he's got a lot of cheap stuff in his portfolio.
Cheap,
but he is not Cathie.
Price has been beaten up.
I think he's legit, and I think that it's probably his forward returns are probably going to be adequate. Satisfactory, as the buff dog would say.
Given the we had an inflation print today. It came in at 6.5. They're expecting 6.2. I sort of know this against my good? Yeah. No, I mean I
don't know.
Literally, I had somebody. The best thing about Twitter is all of the meta takes. You know, like you get somebody tweets out, "Hey, it came in at 6.5, expecting 6.2, so that's red hot." The next person comes out and says it's 6.5, which is down from wherever it was, so it's clearly cooling.
Yeah.
And then you chop into it, and they back out all of the other stuff that's not core or super core, and you get to this: the inflation's not going up or something. But then somebody captures them both and says, "There you go." Like nobody really knows what's going on. But the higher inflation, I mean, if we run at 6.5, then you can't have the 10. And who knows? It's coming down, it's going up, it's going sideways, so I don't know. But you clearly can't have the 10-year sitting at a discount to inflation for a long period of time. If the 10-year comes up, then equity prices are coming down.
Could be right.
This is the caveat that Buffett always attaches to every single time that they ask him if stocks are cheap. And he says, if rates stay where they are, if profit margins stay where they are, then yes, equities are cheap right now.
I mean, it may not matter. We've had a pretty good rally here from October. And clearly over that period of time, you know, things have deteriorated probably, except for inflation has come down a little bit, but 6.5 is still pretty high.
Yeah, if you told someone in 2019 it was going to be 6.5 in 3 years, you would think, or 4 years, they'd be like, Jesus, the market's got to be in the crapper right now.
Tell me where the 10-year is and tell me where the market is if inflation's running at 6.5.
Yeah, I'm sure I think we all would have whiffed on that one, right?
Well, it's always transitory, right? Everybody thinks it's always transitory. That's the lesson that I take from the story that you told a little while ago about the 70s.
Oh yeah. Always transitory until and it will recede and then come back, and at least it did then. I don't know who knows, but.
You gonna say something, Billy?
No, I was just looking back. I mean, this coincides with your crash. I mean, you know, in 2008, it was August 31st, 2008. It was like 5.6. Then it went down to -2.
What was 5.6? The 10-year?
CPI.
Inflation. CPI.
Year over year.
5.6 in August of 2008.
5.5. Yeah, 5.6, 5.7.
Wow, that's.
Well, that was before it got
down to -2. Boom, transitory, bitches.
Well,
Just had to get
Did
there
we
the
have
hard
negative
way.
rates? Did we have
is that
negative
how
rates?
we all want to get there?
That's inflation. Sorry, keep on. Yeah, inflation. What is
a decade of not much?
Yeah, well, rates at zero. Yeah, here's a
I don't
good
know.
question.
Does it lead or is it a product? I don't know.
If
All this
oil
stuff
goes
is
to-
way too hard for me.
If oil goes to structural 120, what does the 10-year? What does the 10-year do? Stuck at 3.7.
Can't live down there, right? I don't know.
I mean, I have no idea.
That's gotta be.
Holy cow, Samson! Congrats, Samson. Tesla's up 88% year to date. ARK's up 30% year to date.
Boom. See that? I don't know why anybody listens to us.
I will say something that the thing.
When's Samson's podcast?
Yeah, like, do you want to listen to us or do you want to make money?
Yeah, exactly.
Yeah, I'm still trying to process those numbers. Tesla's up 88%. It amazes me the volatility of the moves in both of those things. Like Tesla's a huge stock.
Oh, the volumes just mind-boggling.
It's bigger than SPY some days, so it's bigger than SPY often. And the moves on it are just like every single move is like, oh, that was every day is like something completely unexpected happened.
Plus or minus 5% daily.
But ARK
moves.
too, like an ARK's not a single stock. ARK's across, lots of different stocks. And so every time I look at the ARK volatility or the ARK daily moves, I'm just blown away.
Well, it's a rocky road to get to the future.
It's not a
That
straight
is
line.
not untrue.
It is not a straight line.
Can we bang out some quick veggies?
Yeah, let's do some
before we
veggies.
Run out of time. So this is a little piece on Parkinson's law, which you guys may or may not have heard of before, but it's this idea that work will expand to fill whatever time is available for its
that's
completion.
A good one.
Yeah. Originally, it's from this satirical essay in The Economist in 1955 by this guy. His last name was Parkinson, and he was a British naval historian and author of like 60 different books. And his observation came from extensive experience with the British civil service and describing, it ended up describing kind of bureaucracies everywhere though, but he saw how the British civil service interacted and worked. And he explained the growth of bureaucracies. There's two different forces that cause it. One is that officials want to multiply their subordinates, not their rivals, and then and often get themselves promoted by just putting more people under them. And then number two, officials want to make work for each other, so they end up just like creating busy work effectively. So he noted that the number employed rose by 5 to 7% per year, irrespective if there was any variation in the amount of work, if any, to be done by these bureaucracies. So, and it's been kind of weird to watch it. Like if you look at healthcare, if you look at education, and you look at the number of administrators to professors, administrators to doctors, that ratio in the last 20 years has just gone parabolic on the number of administrators to students. It's just been insanity. And so these bureaucracies have just gotten huge. Isaac Asimov had a corollary to Parkinson's law, which he said, in 10 hours a day, you have time to fall twice as far behind your commitments as in a 5-hour day, which I thought was pretty funny. And then there was another little kind of quip in here that was called ingelitance, obviously made up word, but this is the disastrous rise to authority of individuals with an unusually high combination of incompetence and jealousy. And it's expressed in the chemical formula I to the third power for incompetence and J to the fifth power for jealousy. So there's this idea of ingelitance. So it kind of begs the question to me, what's the right amount of time that we should allocate to our investment process? Should it be vary by external factors? Like maybe, what's the value of value at 92nd percentile? Does that mean you should really be digging in today? Is that like the time to be doing extra work? Should you be making a bigger time budget? Or if it's, let's say, the opposite, and maybe like a 2015 that we've talked about where the value of value seemed relatively, tight valuation spreads, relatively expensive market? Should you be just going fishing and lower your time budget?
It's a stock pickers market.
Okay. Oh,
Sorry, dude, keep going.
Let's do that. So, or should time be even budgeted at all, or should it be more freeform, kind of an exploratory, more like jazz approach? I don't have the right answers to any of these things. I just think they're kind of provocative questions that we could be asking ourselves with the idea that Parkinson's law, like, would we actually get more done in our research time if we made it into fit into a box? Like we said, like, okay, you have 3 hours a day or whatever it is that is right for you. Would you actually be more productive and focus on the things that are more important?
Yeah, that's a good question. Probably.
Everything is more important, as Charlie Munger would say. Too many people wasting too much brain power on this stuff. I was at a charity for children, people that need childcare. They raise the money and the children are able to go so the parents can go to work. That is so much more important than this stuff.
Mm. So there was another, Parkinson had this other kind of law, but it was an example of this fictional committee whose job was to approve the plans for a power plant, like a nuclear power plant. Okay. And the joke was that they spent all their time on what materials the bike shed for the employees would be built out of, as opposed to the actual plans for the nuclear reactor. And this now in software development is a very common term. It's called bike shedding. And in fact, like the CTO for Journalytic had explained to me this term bike shedding before, and I'd never heard of it, but I found out that it came from Parkinson originally. And it's the idea that, we focus on these small, easy, irrelevant parts of a problem as opposed to like the hairy, important, hard to figure out parts. And the majority of time in a committee is spent on discussions about these relatively minor and easy to grasp issues. And so that's like bike shedding. So last thing to wrap this up, as an experiment, just because I like to play games with myself on these things, I purposely left only 30 minutes to prep today's episode to see like, okay, well, shit, what can I get done in 30 minutes before we go live to demonstrate Parkinson's law? So I was curious, did you guys even notice that was true? Or
no, I think it worked.
With it? Ah, shit.
I think it worked.
That's the worst case scenario now for me.
I had this idea that I'd do like this, back in the 1800s or something, like 1900s, something like 1800s maybe, where, you have to wait for everything to come by sailing ship or paddle steamer. And it's hard to get information. So your day had to be different. Like you go and have breakfast, and then you go for a walk, and then you come back, and then you do correspondence in the afternoon, and do like an hour or so of correspondence, and that's your working day. That's what I'm trying to get down to. I just want to do correspondence for an hour in the afternoon, and then I'm done.
How's that working out with all your?
I haven't done it yet. I haven't done it. It's not working at all. But I haven't put it into place yet. But that's the goal.
You guys know what Coke's PE was in 2000?
60.
No.
Yeah, 69 for Coke. That's crazy. I think this is why Munger says that like now is not then.
What do you mean? He means
single
like
data
today
point?
is not as crazy as 2000?
Yeah, he said that a while ago.
No, I think he said the opposite. I feel like the last Berkshire meeting, he said that this is the craziest behavior he'd ever seen in last year.
Well, maybe crypto, but not the overall market. When he was at Daily Journal, he was like, this is not nuts. I don't know. I'm an idiot. People should not listen to me.
Notes, but maybe.
I don't think that. I just don't think the stock market's that crazy. It could totally implode, but I just don't think it's that nuts.
I don't think you're wrong. I think there's we've talked about this before, but the technological changes where perhaps these winner take all markets are so huge, they're global in scale, which might be the first time that's existed in that level. I don't know, maybe like someone's yelling at the screen right now about like the Dutch East India Company or something. But where like, and the returns on capital, invested capital, incremental invested capital are so high. These companies don't need any capital from outside at all. shoot, maybe they just do make a ton of money and will continue to make a ton of money. And that competitively advantaged period is open for a really long time. And the market's kind of sniffed that out and is paying a, above a normal, let's call it 15 PE for them, but rightfully so. And they're pretty reasonably priced. And I could buy that argument.
I mean, Procter and Gamble looks like in 2010 or 2009 at the bottom, it traded for 14.5 times earnings. It's 24. I mean, its average over the past 23 years is 22.6.
What's
right?
their top line's got to be growing at like barely GDP, right? So you're paying you're paying like a pretty healthy multiple for a company.
They're probably higher than GDP.
You think so?
Yes. Yeah, 4.8, 7.3, 5.3. Trailing is 2.5.
All right.
I guess forwards 4.1. They take a little bit of price.
Yeah, that's fair.
I don't like Staples. I think Staples that I do think is like a pretty rich part of the market, but I'm just like trying to pick stocks that, I don't know. Like, I think the idea that Apple is now Procter and Gamble, I think, makes a decent amount of sense. So I don't know, is like a 24 PE for that high?
It's not.
I don't know.
Right.
I feel like people would be like, it's crazy. Nobody will buy their phone anymore. And then you ask that same person to forego like 2 upgrade cycles. And they're like, I would never do that. That's crazy.
Here's the problem though, isn't, we always have to remember that this is it's a Keynesian beauty contest in a lot of ways, right? And so if everybody believes that all this same stuff, it's like, these are good businesses, the surprise is likely to be the downside in that situation.
Maybe. I don't know. Sometimes favorites are priced like favorites for a reason.
Who's out there saying though that like, any of these companies are zeros, are, in any kind of trouble? It's not really happening at this point.
Well, I think you're seeing Microsoft and Google bat up against each other. I mean, they may not be. Like, I just I don't know. If you've ever been to a horse track, like, just betting on the long shot because they got good odds is usually not the best strategy in the world. Now, betting the favorite all the time is also not a great strategy. So you got to wait to see the odds you like. But
that's what I'm trying to say, is that the betting odds, I'm not sure you're getting these like amazing kind of mispriced bets necessarily.
Yeah, I don't think we're at a time where, I just don't think we're at a time where I don't think you're getting the odds really anywhere. Like, I don't think the debt market is screaming these great odds. There are probably some microcap special sits. I heard AAMC pitched a little while ago. That was a pretty interesting pitch. There's some. What
would Asness and Greenblatt's 90th, call it percentile value say about the mispriced bets of a quant value strategy right now?
I'm not smart enough. I just say that they're smarter than me, so it's got to be a good bet.
TC, any thoughts on that?
Well, obviously I like it, but I'm biased, and I've been talking for a little while. But yeah, I think there's a relative value trade, which is the spread, and that's however you measure that: expensive to cheap or market to cheap. It's very wide, unusually wide. Has closed a little bit on some metrics, but on others, EV/EBIT as wide as it's ever been.
Yeah.
And I think that the forward returns there are unusually high. And then at the same time, I think the forward returns on the market are pretty modest, but then that's using those cyclically adjust measures. So, in the short term, anything can happen, and I don't really know. But at the same time, there are a lot of those, that inversion still staying very, very steep. I saw the 10-2 is as steep as it's ever been, or like over 30 something plus years of data. I don't know, dude. That 10-3, the 10-year 3-month has an incredibly good track record. Not very many ends. I get that. There are like 4 examples before his paper, 4 examples since. No false positives. Pretty good metric.
That's not bad. I mean,
he fades it. Cam Harvey fades it. Other people fade it. They just say there's too much intervention in the market. Like, it's unnatural. It's not an expression of what's going on underneath. And the other response to that is always, well, what if everybody watches it? Doesn't that sort of negate its utility?
Yeah. Right.
And I don't know. I don't know the answers to those things. So I just, I'm a simple models over expert predictions guy. So I look at simple models. And simple models all seem to say the same thing to me.
I posit a hypothesis that everyone, and I say that, kind of tongue in cheek, but everyone is inclined, if you think that you're going into a recession, to try to hide out in quality and maybe not be in some of these more junky companies that would represent the value basket. And therefore that gets displaced. And everyone's like, well, I know we're going into a recession. I can't hold something with a lot of leverage. This is a bad company. It's bankruptcy risk. Apple, I know they're not going anywhere, so I can hide out there. And if everyone is saying that, everyone's kind of standing all on the same side of the boat. I mean, isn't that where you get opportunities? Is that type of thinking and that sort of dynamic playing out?
And it's easy to understand the reasons why people don't want to hold a lot of those. The cheap stuff is that the argument there would be, well, it's full of oil companies that have had a good 2022, and
those
so you're getting them on a
earnings at all, right?
They're over earning, so you're not getting a cheap price. You're getting it's just identifying over earning companies.
Yes, exactly.
That would be the rebuttal.
But I just don't know that the rebuttal's any different at any other point in time. I don't the opportunity exists because people don't want to hold them. Whatever the reason is sort of beside the point.
Yeah. I mean, look, you're right. On the other hand, management teams might be incentivized well for now, right? I'm not sure commodity companies generally have proven managements that allocate capital very well over time. So if you want to own it,
except for gold miners, they're known for.
Well, to be fair, I'm glad you gave that
Let's just talk
example.
about how hated oil is. Okay, let's just talk about it for a second. If we assume ExxonMobil is a reasonably good oil company, I mean, it's a $500 billion company. That, I mean, it looks like the previous decade normalized free cash flow was I don't know what. Let's see. Looks like from 2004 to 2010, call it 20 billion. From 2010, 2010 to 2020. Let's even forget the $3 billion negative cash flow. It was probably 15 billion. So what's $500 billion divided by 15 billion? I mean,
no one knows.
Yeah, I don't know. Is that hated? I don't know. Now maybe it earns 60 billion in perpetuity for the first time ever. That's very possible. But every other discussion we ever have is mean reversion. So I find it hard to think that mean reversion wouldn't apply to a commodity company over the long term. So then I gotta buy into an over earning asset because it's cheap. And then when I get waxed when the earnings come in, I got to figure out how long I want to hold that. I'm not playing that game. Fuck no.
But if you take
I want nothing to do with that.
Capital returns, capital theory, where you say there's been, it's not hard to figure out why the oil companies have had a bad decade, right? It's a combination of low oil prices and ESG being quite loud and impacting the way that people invest.
I don't know that it's ESG. I really think that that's a little bit overblown.
It raises their cost of capital. It makes it harder to raise money.
They don't need to raise money. No oil company is going out to the equity market. Exxon, when's the last time Exxon issued shares because they needed to issue them?
It's not just the majors. There are juniors that are, investing in various different places, and they're the ones who do need access to the market, and they do it.
Wow. But is that ESG, or is that they all snorted cocaine and went nuts on shale and blew a bunch of money?
Yeah, I mean that's true.
So
that's right as well.
I don't know. That's not ESG.
That might have been G, actually.
It's fair.
But the gold companies are a good example. Like the gold companies have had, they've also had a bad decade. But the ones, and I don't know if it's I don't know if they've necessarily done it out of the goodness of their own heart or an attempt to get their governance to a good place. I think probably they've had it forced on them by the market, but they have got some discipline around spending, and they've tidied up their they've tidied up their shareholding, and they've done a lot of good things. So like they are in a good place. And I don't disagree with you. Like if they get a good run, the oil companies there'll be a whole lot of silly mergers. They'll pay themselves big bonuses. They'll do all of the dumb stuff again. But you do have that period of time now where, they look better than they have. And I'm not necessarily saying buy gold companies. I don't know. I'm just saying as an example of the way that it would work, that's what would happen. So you might be paid to do it now.
I mean, we're all racing the clock in different ways, right? I mean, if you're buying a super high quality, moated company, you're racing the clock that moat's going to stay intact and grow over time, hopefully. If you're buying an over-earning levered,
I think I don't think
company,
this is true. I think this is the wrong takeaway from Buffett's career. I think the right takeaway is look for C's and look for Geico, and look for things that get stronger over time and and rather than racing the clock, you're running with the clock. That's what I think the actual takeaway is.
But I don't think that's such a tiny, tiny sliver of companies that.
Then why spend time on the rest of the bullshit? Why not just try to find those small slices of companies?
You're probably not wrong.
This is
the rest of the stuff is just like whatever.
Relevant to the exchange. There's a Steve Jobs and Bernard Arnault, who's the CEO of LVMH, richest man in the world at the moment. He had an exchange where Jobs wanted Arnault to take care of the Apple stores, and he said Jobs was worried about the sustainability of high-tech products. And I don't know who's saying this, but I think he then said to me, this is Arnault describing Jobs. You have eternity for you. I asked him why, because I sell iPhones, he replied, and the iPhones, will they still be around in 25 years? But what I'm sure of is the world will continue to drink your Dom Perignon. I don't know.
The Apple store is so good. Like the implementation of how they did that was so good. That was really something. I'm really glad that I thought that stock was too expensive my whole life when people were lined up to buy them in a fucking recession.
Yeah.
In 2009, when people were lined up and they were building new stores. And I thought, man, the PE's too high.
Get it like a 10 PE.
Would have changed my life.
It's got cheap. It's got cheap. It gets cheap.
Hey,
I mean, it has got
Bill,
cheap in the past.
Bill, you owned Berkshire.
You didn't have to wait.
So you owned a big chunk of Apple. You're all right.
Yeah.
Look through.
Yeah. I'm an idiot.
We made it, dudes.
We made it.
Thanks.
All right, Jen.